Good evening, everyone. I welcome all of you in this MSME Financing Scheme webinar organized by MSME and Startup Committee of ICI. So today we have with us our two dynamic speakers, Shri Sandeep Verma ji and Shri Shiv Trivedi ji. I welcome both the speakers. I also welcome my chairman MSME and Startup Committee, Shri Dheeraj Khandelwal ji, our secretary Dr. Sambit Mishra ji, and all the members attending this program. So friends, as all of us know that MSME is the India's growth partner in the nation building. And as on today, if we see worldwide, the contribution of MSME to the GDP is approximately 60%, whereas in India, it is 40%. So there is a huge scope of MSME in India, and government has also introduced various schemes for the MSME, like with credit guarantee scheme, which was increased from 2 crore to 5 crore on 31st of March 23. So now any MSME without any collateral security can get bank loan up to 5 crore rupees from NCD. And also various invoice discounting schemes are there. So today our speakers will elaborate all the finance schemes available with all the MSME. So now I request my chairman, Shri Dheeraj Khandelwal ji, to please welcome all the dignitaries. Thank you.
Thank you. I think
due to network issue, the chairman has disconnected. So that I am handing over the session right now to Mr. Sandeep Verma, CEO, CGTSME, MSE, to his further sessions.
Thank you, Dr. Samit. Dheeraj ji ko bhi dhanyavad. Of course, he is not there, but he would join soon. Basically, that was the genesis when we met Mr. Dheeraj ji. Then I was kind of telling him that this scheme, which has been built for MSCs in particular, should be popularized, and what better forum than the office of ICAI, through which it can definitely be taken to the needy people, both in terms of the MSE borrowers as well as the lenders, because these two are the main stakeholders for our scheme. So as Sambitji was telling, that we all know that MSMEs play a very, very important role in trade creation and in the economy building. Uh, One important aspect which has to be kept in mind, that as per UK SINA committee also, if you would recollect, the total credit requirement of MSME segment is about 37 lakh crore, out of which only about 15 to 16 lakh crore is the formal credit that is happening right now. So what he estimated, that there is a gap of 20 to 22 lakh. Somebody puts this estimate at 25 lakh crore also, but that much gap is there. So basically our credit creation ratio to the GDP is only about 53% and all, and there is a huge credit gap. Now, if you compare it with the developed countries like China and other, China, it is 187%, even Vietnam and all, it is 125%, where we are hovering around 55% and all. So there is a huge need to increase this ratio. And where do we increase it? Because in the large corporate segment, or even in the medium segment, as per the Niti Aayog report, the gap is substantially less. The credit gap is largely existing in the micro and small enterprises, and more so in micro enterprise, where the data is collected. The micro is when even TransUnion, when they take micro, micro in the terms of amount. So less than 1 crore they consider as micro, and basis that they calculate their data. So it is established there is a huge credit gap available in the micro and small, which needs to be met. Now, when the experts speak about it, two ways are arrived at or thought of, which can lead to this. Because the credit rationing results, I mean, the moment that you base your entire thing, the lending, on the balance sheet or the asset-based lending, the problem is that the rates start increasing, and once you start increasing the rates, then there is a situation where you are left only with the suboptimal borrower, because the good borrowers will be left out, and which is, we all know, it is called the credit rationing situation. Now, to avoid that credit rationing, two ways could be relied upon. One is a move from the traditional way of lending, of asset-based lending or the past-looking lending, to the cash flow-based lending, which nowadays it has become very easy with the help of account aggregator, machine learning, AI, data analytics. With all those things, the forward-looking lending has become a done thing today. And most of the banks, they are also moving from traditional way of lending to this. The other way, where the cash flow based lending is happening, the other way which can supplement it is to move from the collateral to a guarantee based system. So that also, in a way, it helps substantially in meeting the credit gap and doing the credit supplementation work, and removing the problem of credit rationing. With that thing in, and there is another angle also to that, because the credit creation is a ever increasing thing. Now, the solution that we are trying to achieve for stimulation of economy, and if we want 5 trillion economy, as Honorable Prime Minister says, so we all realize that it can happen only through the micro and small enterprises, because the medium and the large scale corporates would have limited impact on that. Mostly it has to be with the micro and small. And let's not talk only about 5 trillion, because if we start talking in terms of, say, 100 years of Indian independence at 2047, what happens? So the credit creation would be huge in terms of amount. Now, if we all continue to believe that collateral is going to be the answer of the day, then that is going to meet with some realistic position that I and you together are going to face. Because what we are trying to do, we are trying to solve a problem which has infinite dimensions with something which is finite. The collateral, as we all know, it's finite. I mean, you cannot have unlimited collateral to offer. A time will come where there won't be any unencumbered asset available, and more so for this segment, that is micro and small, to offer for credit creation. So credit guarantee as an instrument of credit enhancement is the tool, basically, because this also is a function of capital. So as the capital creation is unlimited, infinite, so is the credit guarantee. The credit guarantee works with the credit multiplier effect, where the problem of a few are shared by a large number of members. So this also essentially is a function of capital. So if I need to create capital creation or the credit creation, that can be backed by guarantee, which also is a function of capital. So technically or essential, this also would have infinite dimensions. So this perfectly matches if you think in terms of long term. This is at the macro level. Even at the micro level also it makes sense, because as long as you have two options available to you. Of course, we'll come to that once we start the presentation. And without much ado, let me come to the presentation and we talk about it. And I would very much appreciate and like if it becomes more interactive, in a sense that post my deliberations, if the questions and queries are there, I'll be more than happy to reply to that. We'll start with the presentation and we'll proceed as it comes. I hope it is visible. Yeah. It's not moving. So this is this in nutshell is what we have been doing. CGTSME is the first credit guarantee institution. It was set up in year 2000 by two settlers, the two settlers being the Government of India through Ministry of MSME and SIDBI. So we have completed about 23 years of journey. It is mostly a system-driven program operated by a very small team. We are a single office. People, about 40 people are there. We are all based out from Bombay, and from there we are operating this scheme. And we have about 150 lending institutions through which this scheme is being launched, and different schemes are there. If I talk about numbers, so far we have been able to provide a guarantee for more than 4 lakh crore worth of loans. So this is some achievement, and more than 7 million entrepreneurs have been benefited. And what makes us feel good, that it has been an inclusive growth story where 21% women have been covered, and even the SC/ST's percentage has been in the range of 6 to 7%. So it has been an inclusive growth. So this is a brief elaboration of what I talked about, that the number of guarantee and all. And the estimated employment generation is 1 crore 81 lakh. But I must tell you that this data has to be taken at a very conservative. This has been taken at a very conservative level, because normally that data which the ministry and the Niti Aayog says, they say that per unit it is about 3 employment that is getting generated. That is the minimum. So considering that if the 70 lakh people are enterprises have been assisted, so very conservatively speaking, it should be 7 3s are 21, so 2 crore 10 lakh, and it would be even more. So 1.81 is the data which the bankers have given me, given CGTSME, and that is what being shown. Another important point is to be kept in mind is that this data is the direct employment that is happening. Nobody talks about, and nobody captures. Even now, even the startups and all, they don't capture the indirect impact on the employment generated. So this is direct employment that has been generated. The objective when the scheme was set up, the objective was very clear. The objective was to facilitate collateral-free lending, because we all know, you are also in the business of knowing how credit takes place and all, and we all are aware that access to credit remains the biggest problem. I mean, at times it is proven that more than the cost, it is the accessibility of credit which is the main problem. And in accessibility of credit, availability of collateral happens to be one of the major problems, because unlike large corporate and all, these people do not have a credit history, neither nor do they have any collateral to offer. So this becomes a pariah kind of a thing which nobody wants to touch. So this is the basic problem. Now, to overcome that problem, CGTMSE was established where we were supposed to step into the shoes of the borrower and give a sovereign guarantee to the lending institution that, okay, look, if the account goes bad, then I will come forward and make good for the losses that you are incurring. So about 75% is the standard guarantee that we'll give. In some cases, even it is more. The benefit to the borrowers are obvious, because not having collateral is not a handicap for them. And if the collateral if the guarantee is given by us, it is a sovereign guarantee. So their rating also improves a few notches, which enables them to bargain or to get a cheaper credit rate. The benefits to MLIs, which is the lending institution, this also is very obvious, because the individual's responsibility gets substituted by an institution, and that too by a sovereign. So since it is a sovereign guarantee, so their life becomes much more easy. We all know that what kind of difficulty one faces when one goes to recover its loan account and all. Apart from that, this being a sovereign guarantee, the capital charge is not there, which has a huge impact, because the money can be put in rotation, and a multiplier effect could be there in further credit creation. Likewise, that IREC norms also does not apply. The provisioning is not required to be done and all. So these are the advantages that the lending institution get by coming to our scheme. We all know the definition of micro, small, and medium. Suffices to say that we cater only to micro and small. The idea was to cover the medium also, but as I said, at high level, this thought was given due weightage, that the credit gap is more in micro and small as compared to medium. So it was thought that where the credit gap is more, the institutional or the government support should be more in that segment. So for the time being, it has been decided to keep medium out of the purview. The various schemes which are there, if I start from the bottom left-hand side, that CGS1, it is credit guarantee scheme for the banks. These are the conventional and time-tested lenders which have been under our fold right from the beginning. Then going forward, we have included NBFCs also under our fold. And remaining four are kind of different schemes that we run. That is, the one is PM Swanidhi. You all are aware that Ministry of Urban and Housing Development, they have launched their scheme for urban street vendors. So we are providing guarantee to that. Then a hybrid coverage. This also is a piece of information because which can come handy to you, because when we started, the idea was that wherever collateral is not there, CGTMSE used to enter and provide support. But it was later on, it was found that this was having some kind of a weakness, in a sense that even if the collateral was not of sufficient quantity, it still was not in a position to make any impact. So take, for example, that a loan of 1 crore is there, and there only 10 lakh collateral is there. So earlier guidelines used to say that since there is a collateral, CGTMSE could not make any intervention, because it was take it or leave it. Either there is no collateral or CGTMSE does not enter. So more than helping, it was kind of creating a situation where obviously when the bankers, they see that at least 10 lakh is coming, so they would prefer that. So this was coming in the way of more support coming from CGTMSE. So a hybrid model was introduced where this is basically for in such cases where the collateral security is there, but may not be in the right quantity or right or in the right volume, leading to lending institutions getting some kind of discomfort. So 1 crore, if only 10 lakh collateral is available, then the new scheme or the new guidelines provides that this 10 lakh can be knocked off, and balance unsecured loan, which is 90 lakh, that can be covered. So this is the hybrid and retail product. Again, this was now as you are aware that retail as well as wholesale trade both are made eligible activity under MSME Act. So they have been brought under our guarantee scheme. And why I'm mentioning it specifically, because earlier the retail activities were kind of treated differently, in that the fee used to be high and even the coverage also was limited only to 50%. So, but now the retail products have been brought at par with our normal manufacturing and service units. That's why special mention has been made. Apart from that, we have been collaborating with various state government. I will talk about that in a bit. This is some of the a major thing which when we talk to the bankers, we talk about it. And since you also deal with the bankers in a big way, so perhaps this would be required to know about it. And this deals with the common perception that the bankers sometimes they have, and the actual situation which may be existing. Like for once, the bankers, I also am a banker, so career banker. So commonly that belief is that the taking collateral security is better. Basically, it happens that people feel that if you have a collateral, the borrower, I mean, since it is tangible, then you know that it is there with you, and the giving loan becomes that much more easy. But actual reality, if you see, the situation is not like that, because if you take collateral, it comes with a huge responsibility on the part of the lending institution. Each time you have to get it valued, each time you have to get it the title search, the fraud, etc. could be there. The same property could have been mortgaged to more than one lender. So all these problems are there. Apart from that, once you go for realizing the security, you find it too difficult. The legal process is such that it takes a lot of time and all. So actually, this does not help you much. I mean, this is a very traditional myth, along with the fact that many modifications have been made in our scheme also. Like, of course, it is mentioned here, the last point, the legal action not required for loans up to 5 lakh. Actually, it is 10 lakh. So for loans up to 10 lakh, there is no legal action required. So the simplicity of the credit guarantee scheme is much ahead compared to a collateral based lending. Then the second myth normally people have, that if the collateral is there, then the borrower will behave. And since I can put pressure on them and they'll behave. Now this thought also was good only when we used to work in silos, where the left hand didn't know what the right hand is doing. So in that scenario, perhaps this was more applicable. But today, with the account aggregator, bureau report and all, the borrower knows that if he makes a mistake in one bank, that is the end of career for him. So even after that, if something becomes NPA, it could be only because of two things. Either the project was actually not manageable and genuinely it become NPA. In that case, also collateral does not help. Or the other way around, where there is an ulterior motive. In that case, also the collateral does not prove anything, because the person who is coming with ulterior motive, I mean, I and you know for sure that their collateral also would not be, spick and span. There would be some doubts on that also. Then the myth is that the guarantee is costly. It is no longer so, because we'll again show going forward, the rates have been reduced substantially. So it's no longer costly. Then being a government agency, sometimes it puts some negativity in the mind of the lender or the participants that, okay, the government is giving the guarantee, where the guarantee claim would be settled and all. So now the data is showing that 100% claim is processed within 3 weeks and 90% is settled. So the pending, if you see, it's less. And this is also corroborated by the fact that year on year, for the last 2-3 years, the quantum of guarantees guarantee being issued is showing tremendous jump. So if you see the backward calculation, so unless until the claim settlement process is robust and the bankers are satisfied, they would not be coming for renewed guarantee, for availing renewed guarantee. So that itself is a testimony that the bankers are by and large happy with the settlement process. And this apprehension also is not very substantial. Then, of course, the cumbersome process, apart from security, no advantage to bank. All these things are, once I base my thing on the technology, as I said, that only 40 people are managing, and now we have gone for API integration also. So the bankers know that the maintaining and running the scheme is no longer cumbersome as it used to be. I mean, in some distant past, it obviously was a point to consider, because at that time manual entry and all those things used to be done. But this is no longer the case. Then the coverage also 75% coverage, and whether they should, for loans up to 10 lakh, whether they should come to CGTMSE or go to NCHTC, these doubts are there. But these are merely technical, because 75% coverage in itself is not less. But let me tell you that in select cases, we give guarantee to 85%. And in some of the states, again, I'll tell you about that in a bit, that the coverage is as high as 95% to 100% also. As you may be aware that recently the government has placed 9,000 crore worth of corpus with us, and that has enabled us to take a number of initiatives. So we have been taking initiative for last 1 year, but the three major initiatives which we took this year with effect from April, these are these are worth mentioning. One is the guarantee ceiling has been enhanced from 2 CR to 5 CR. Waiver of legal action, which I touched about, it has been raised from 5 lakh to 10 lakh, meaning that for loans up to 10 lakh, the precondition of initiation of a legal action is no longer required. If a loan is having outstanding up to 10 lakh, it becomes NPA. So without initiating legal action, also the banker can come and we can settle the claim immediately without waiting for the legal action or the resolution thereof. And the most important thing was the fee reduction, which has been reduced from the peak of 2% to as low as 0.37%, and over and above that, we give discount also to better performing MLIs, that is lending institution. One thing which would be of interest to you is to note that the eligibility ceiling, which has been raised to 2 crore to 5 crore, it is not the ceiling on the loan amount. It is the limit to which the guarantee can be issued. So suppose there is a loan of 7 crore and that person is able to bring collateral worth 2 crore. So that 5 crore could be guaranteed under our scheme. So this limit is not to be confused by the loan amount. Technically speaking, a loan of 7 crore, suppose he is not bringing anything, any collateral, still I can give guarantee up to 5 crore. In that case, the balance 2 crore remains unsecured for the lender. But the initial 5 crore, on that I give guarantee of 75%. So total they get covered for 3.75 crore. So these are the other initiatives that we have taken. As I said, the trading has been allied with our normal manufacturing and service activities. And on the top 4 blocks that you are seeing, rather 4 and the left one, the people with disability. So considering that these people are disadvantaged people and there has to be some steps taken to support them, what have we done? That for any loan which are given to this group of borrowers, like anything which is coming up in the aspirational district, or any loan which is given to women, SC/ST, or the physically challenged, or any loan which are given to unit which is getting Z certification, zero effect and zero defect certification. So what we do that we give 10% reduction in the fee and enhanced guarantee coverage also. In all such cases, the coverage is up to 85%, and the fee, whatever is the applicable standard rate, we give 10% guarantee fee. And that's not all. These rates are in a sense aggregating, in a sense that if one women entrepreneur who happens to set up a unit in aspirational district, acquiring a Z certification, then she stands to gain 30% reduction in the fee along with 85% coverage. Then after formation of Jammu and Kashmir, the UT of Jammu and Kashmir and Ladakh, you know that we have a special status for northeastern states where loan up to 50 lakh is given higher coverage, 80% coverage is there. So the same benefits we have passed on to the UT of J&K also. And then we have also included the MFI and other institutions. Cooperative banks in a big way, they are getting inducted into the list of eligible institutions. So the number of eligible institutions is increasing tremendously, because our view is, or our thought is, that more and more MLIs should be made part of the scheme, so as to enable us to reach to every nook and corner of the country where the MSEs could be benefited and helped. And of course, the benefits to Agniveer, it is a futuristic kind of a scheme, but we have already said that anybody who is getting a loan under the Agniveer scheme after completing their short service in the army, so they will be given the best treatment that is available at that point in time, meaning that concession, whatever I talked you, that 10% concession would be there, and a higher coverage that would be available to them also. Apart from that, as I was telling you, that we have entered into special collaboration with various state government. So here what happens, that CGTMSE's share of guarantee is provided as either to 75% to 85%. And the state government provides additional guarantee up to 10 to 15%, taking the total guarantee available to 95 to 100%. In some cases in Northeast, like in Assam and I think Meghalaya, we have done 100%. Remaining places, it is 95% and odd. And one state is missing here, which is Goa, which where we have signed it recently. So now with 6 states, we have this collaboration, and this collaboration is very seamless, in a sense that the lending institution or the borrower, they would not know that 2 people are standing behind the guarantee support. For them, it is the business as usual. What happens, the mechanism is like that the government keeps the fund with us, and in the event of any account becoming NPA, I settle the amount as either do. The only problem or the only difference is that I give my money, and I also give the money of the government. So the enhanced guarantee, I be the face of the scheme. So the borrower MLI, the system does not have to change a bit. The only thing, the coverage which used to be 75 to 80% now becomes 95 to 100%. So it gives even more comfort to the MLIs to reach out to these micro and small enterprises to give loan to them, because obviously higher the coverage, more comfortable they would be. And apart from these states, many more states are also in the queue, and or rather I should say that I am in queue with them, and we would be getting it done. Prominent among them are the state of Maharashtra, where day after only a meeting is scheduled. I'll be going there to talk to the state official. Government of Uttar Pradesh is showing interest. Government of Odisha is showing interest. Government of Andhra and Government of Telangana, both of them are showing interest. Government of Jharkhand is showing interest. Government of Bihar, almost everybody is showing interest, because as you know, it's a multiplier effect. A small amount also, if they give, the impact or the support that it provides to a portfolio is about 50 times. So it makes sense for the state government also to contribute a small amount, which will go a long way in facilitating collateral-free lending in these states. Now, these are the salient features of the scheme. As I said, that up to 5 crore it could be covered. The hybrid and partial collateral, we have talked about, 75% to 85% coverage is there. Then any activity which is defined as an activity under MSME Act, they would be covered under our scheme. Suffices to say, one does not have to break his head. Suffices to say that purely agricultural activity is no. Purely agricultural, I mean that buying of seed, doing cultivation and all. But if there is also some backward or forward linkage impacts are there, then agro-based industries are there, or warehousing is being created and all, even those can be covered. The other good thing that we have done is the anytime guarantee coverage we have done, because initially what was happening, once you give the loan, within 1 quarter, you are supposed to come and take guarantee. So that was kind of a problem for the bank, that if they must miss the bus, they miss the bus forever. So now we have changed that, and we have said that even if you have not taken the guarantee in the initial stage, at any point in time, you can come to us and you can take guarantee, provided that the loan should have shown some maturity, and should not have gone into SMA 2, or should not have been restructured in the past time to be covered under guarantee scheme. So the issuance of guarantee is this is in nutshell a process which is being shown. The process, the loan proposal is received by the bank, the loan is sanctioned by the bank. Now this in this I also have put in a system in place where the guarantee would also be known. The guarantee amount, the eligible guarantee amount also could be known ab initio to the bankers, meaning thereby that that you all know that PSB online is there, and we have our own website called Udan, where any individual can go, he can punch in his data, and we have some API integration with TransUnion Sibyl and the GST, and also the data could be fetched from there. And basis that, and that then we also see our internal data, and basis that we give a provisional certificate to the borrower, so to the prospective. That guarantee would be a certificate stating what is the amount for which he is eligible for availing a guarantee. Now this adds to his confidence when he goes to a lender. So he shows the certificate to them. So it is no longer only after the loan is sanctioned and then only they come to know whether the guarantee would be given or no. Now this situation is we are putting the horse before the cart, and we are telling them that you would know even before sanctioning your loan whether the unit is eligible for a guarantee or not, and if so, what is the amount they would be eligible for. And after that, the usual thing is that the bank logs into CGTSME portal, CGT guarantee application is submitted. Now this submission also, as I told, it is happening at 3 levels. One is the individual data entry, that is still there, but that is becoming fast obsolete. Then we have bulk upload, where say 100 entries are to be done. Then all the data, it is uploaded bulk by the bank, or even we can do that. And the most thrilling thing that has happened is the API integration. We have already done API integration with about 15 banks, where with a touch of button, all the required data automatically will flow from the bank's CBS to our system. And you would also be happy to know that the guarantees are being issued round the clock. It is real-time guarantee being issued, because see, it's technology has to be leveraged like that. When we sat down and saw the guarantee process, then the question that we asked ourselves was that while doing it manually, what is the value addition that we are bringing to the guarantee process? Because the entire thing is, parameterized. So if it is parameterized, what is the additional value that I am bringing? And if I'm not bringing anything, then why can't I do it a thoroughly mechanized process of guarantee issue and reduce the TAT? Now with that, this is what actually has happened. Now the system says that all the parameter ticks, then it comes to my system. The entry point, all the getting criteria is seen and verified whether they are met or not. And if they are met, then it comes into my system and guarantee is issued then and there, and advising them that what is the amount to be paid by them. And once the amount it pays, the guarantee is issued and becomes live. So when I speak to you, even now some guarantees are being issued. Even at night, if somebody is there who is forwarding the application at that point in time, even at that point in time, some guarantee is being issued. Even on Sunday, we are issuing guarantee. I mean, the amount is not huge, but each Sunday I have seen about 25 crore, 30 crore, 20 crore, this much amount of guarantee is being issued. And this has reduced the entire work or entire timing that is required, both at the MLI level and at our level, substantially. Just one perspective would actually, one data will give you some perspective that about 3 years back, 100 crore worth of guarantee was getting approved per day. So that was considered to be a good amount, and that also was achieved by CGTMSE after a lot of history and all. Now with technology and API integration and systemic changes, the guideline changes, I can tell you that today the per day the guarantee issued is ranging from 500 crore to 600 crore. So in 2-3 years time, the per day limit or the per day guarantee that is being issued, it has been raised from 100 crore per day to about 500 to 600 crore per day. Like I can give you the example, yesterday we issued guarantee for a 681 crore. So this is the level of operation that can go up. At the macro level also, if you see last year, that is the year before last, 22, we approved guarantee for 56,000 crore. Last year, it got almost doubled and we issued guarantee for 1,04,000 crore. So from 56 to 1,04,000, it was a huge jump, and a jump which was appreciated by none other than Honorable Prime Minister also. That you would appreciate if you see in the total context. The total context, as I told you, that we have done total 4.2 crore worth of guarantee approval in last 23 years. Out of that, about 200 crore, 2 lakh crore has been done in last 3 years. So you just imagine that whatever we have done in the last 20 years, almost the same thing we have done in the last 3 years. So this is the speed at which CGTMSE is working. Why it is essential to tell you this? Because when our request to you would be that when any borrower comes to you or when you go to the bank, please please dispel the myths that they may be having, not only about the scheme but also about the operational mechanism that we are having. Many a times the awareness would be missing, both at the borrower level as well as the lender level. Another thing which I would tell you, that the rates are before your eyes. I mean, you can see that the rates have been reduced substantially, and above 1 crore and above 2 crore also, it looks slightly disjointed, because up to 1 crore our prime target was. But I assure you that very soon this 1.2 and 1.35 also would be changed. So this is the demand side. I have reduced the cost so that the demand side there is no problem. I mean, the borrowers do not feel the cost, or do not feel the pinch of the cost of borrowing, and they are willing to take guarantee. On the supply side, I have done all these things: the operational convenience, the guarantee coverage, increase in guarantee coverage, operational convenience, collaboration with the state government where the coverage is going as high as 95 to 100%. So I am trying to tackle the issue of guarantee from both sides, the demand side as well as the supply side. My request to you would be that when any borrower also comes to you, the borrowers generally, I have also seen my life, and you deal with them more than I do. So you also would have seen that they become very anxious. They are so much in requirement of a loan. So they are willing to offer whatever is there in their hand. They offer it to the bank, that whatever is there, you take it and give me loan. I mean, this is the kind of desperation they are in. I mean, this leads to a lot of problems for them, which they may not realize at the time, but subsequently it becomes a problem. One is that the size is the problem. They take a loan of 10 lakh, but they might be willing to give a collateral security worth 40 lakh to them, because at that point in time, this 10 lakh is very important. So very soon, this volume of the collateral security, it evaporates, in a sense that once that 40 lakh loan is there, then the security margin of the banker, it reduces from 4:1 to 1:1. So that is one challenge that the banker faces. When they go to their sanctioning authority, they say that security margin is going down substantially. They will never comment that it was very high to begin with, so it's coming down is all right. But nevertheless, that is a problem. Number two, with this, the borrower gets married to a bank, even if they are not happy and all. If they want to shift also, it really becomes a problem, because collateral is mortgaged to them. The banker would have its own tantrums in shifting, allowing them to shift and all. So that is the kind of problem that you have. The biggest problem is that, I mean, the common sense says us that whenever two options are available to us, we should go for that option which is not going to be there in future. And the other option which is going to be there forever, that I can save for the rainy day. Now, this is what I would like you to suggest to the borrowers also, that even if they have the collateral to begin with, it is good that for loans up to 5 crore, they rely on CGTMSE's scheme, because this helps them. The cost is less and all. And once they grow, even if the collateral that they are having, let that be used once they cross this 5 crore limit, because after 5 crore, this guarantee facility is not there. After that, only collateral is there. So if they use this collateral security, which they have in their arsenal, if I call it a weapon, if they use this weapon even before the 5 crore threshold is reached, then beyond 5 crore, they'll not have anything because the collateral has already been used and there is no guarantee available. So when the prudent sense, the common sense would tell that use that option first, which is not going to be there after certain time or after certain limit. And once that threshold is achieved or crossed, then only you go for the other option. So this in nutshell is about the presentation on CGTMSE. The purpose of this meeting or this webinar, when I talked to Dheeraj ji also, and was this precisely this, that whatever good things about the scheme is there, let it be propagated. The bankers are getting very comfortable. They are very comfortable, as I earlier also said, the proof of pudding in eating. If the bankers were not comfortable about the scheme, believe you me, I mean, the kind of growth that we are showing in the last 2-3 years, it would not have been possible. Nobody, I mean, in Hindi there is a kahavat ki kaat ki handi baar baar chulhe pe nahi chadti hai. So our claim settlement ratio also has improved. The settlement, as I said, that the guarantee approval has been increasing. So is the claim settlement. Claim settlement, what I settled in 2021, it has gone 3 times in 2023. I mean, I request you to put your questions, which, I mean, if you have any question or any query, we can take it up. Even after this also, after this webinar also, if anything is there, please be in touch. I can see some questions which is coming. How an garments export house benefited from MSME umbrella? One, I mean, I'm not very much aware about what other facilities are there, but of course, the export house of this thing would definitely be benefited by another thing which you are also aware, that once this low income tag of Bangladesh and Vietnam is going away, so textile market is going to have a huge export potential, and that is the bankers will be more than willing to cover. But in any case, they are eligible for our guarantee scheme. So guarantee scheme does not differentiate between a garment export house or any other. Whatever loans they take, that can be covered under that. So CGTSME provide loan to contract firm, fee charge bank yearly based on original sanction. No, this the fee is not charged on the original sanction. It is charged on the outstanding amount. So this is again a change which was brought about 4-5 years back. So the fee is charged on the outstanding, so that the regularly paying borrowers are getting benefited. Otherwise, if you go on charging on the sanction amount, they are kind of discriminated against. So what are different method of finance? The my clients base are very huge, and the customers pay after 3 or 6 months. Now this is a delayed payment issue, and of course trades is there and all. I can share with you a good news that very soon we are going to make an entry on trades platform also, and in trades particularly now my role becomes much more important, because there also with the broadening of canvas, their slightly lowly rated buyers are also getting onboarded, and NBFCs are also getting onboarded. So initially, why we are not making a mark on that? Because the AAA buyers, they are very touchy about the fee, and the guarantee fee of very meager amount, also 50 paisa also would be seen a burden by them, and they would not, because the CPs and all on that they used to lend. But with now slightly suboptimal buyers coming there, and NBFCs also B positive or B minus NBFCs coming over there, then the scope is there, and maybe in a month's time or 2 months' time, we'll be introducing one scheme for trades also on trade platform. So that would further increase the resilience of these trades also. And another thing is that I don't know whether you are aware or not, that one scheme has been made GST Sahay, which is essentially what UK Sinha committee talked about, the second window, where without bringing the buyer into the picture, the bills could be settled. So as you are aware, the second window has not been allowed because trades recourse to the seller is a big no-no. Whereas in second window, the recourse is to the seller. Because of that, it has not seen the light of the day. But GST Sahay is doing essentially the same thing. Wherever the seller is there, whether it is seller's invoice or a buyer's invoice, based on the GST invoice, the amount would be discounted, not discounted, it's called the loan against the invoice. It has been started on a pilot basis by SIDBI, and we are there in that case also, will be providing guarantee. So these two schemes, which slightly are related to the query that you are doing, that my clients' big bills are huge and customers pay after 3 to 6 months. So this would be taken care of by these two scheme, trades and GST Sahay, and where we are going to make an entry in a month's time or so. Does a CA firm allowed to get registered as a MSME? I doubt it is there, because MSME, you see, as an individual, one can definitely can go and do it, but it has to be a commercial loan. So I don't know. I just plead my ignorance, because this technically it could be also, because a professional like a doctor, if he is opening a clinic, certainly it can be done. But I'm not very much sure about MSME. So this I can check and I can come back. I'm just going through some of the queries. While this scheme is to be encouraged, many branch managers are shy of lending in the scheme as they are afraid of disciplinary action, cause of failure of the loan. What action concerned person? In fact, my about the question number 4, I'll say it's a question Dr. Samit Kumar Mishra has put in. Sir, precisely this is the reason I say that the bankers should go more for this credit guarantee scheme. See, I have been heading HR of SIDBI, and believe you me, that 80% of the staff accountability issue used to be linked to the cases where collateral has been taken. Wherever you take collateral, it leads to a lot of responsibility on the part of the bank manager. As I was telling, you have to get it valued every year. You have to take title investigation each year, and more than that, there always will be a question. See, normally what happens when you sanction, at the time of sanction, a collateral will have a value of 100 rupees. At the time of NPA, the value would be 50 rupees. And when you go to legal action, it will be 30 rupees. And when you actually resolve it, it becomes 20 rupees. So this is always questioned by the authorities, that either at 100 rupees it was overvalued, or at 20 rupees it is undervalued. Now, guarantee is the thing where the value remains the same. So precisely my point is, sir, I mean, this is what I look upon you to kindly educate the people, because the guarantee scheme, the only care you have to take, that your guarantee should remain live. If it is remained live, no question asked, neither your disciplinary authority would ask anything, nor CGTSME would ask anything in settling the claim. So for that aspect also, this would be a great saving for them if instead of collateral, if they go for CGTSME's guarantee scheme. Then the question number 5 is, in the case of small firms, whether registration is compulsory. Sir, nowadays URN is becoming compulsory, and in fact it is good. I mean, we all know about 6.34 crore MSPs. Only 1.25 is registered. Now the problem is that once they are not registered, they are out of the formal segment of the sector. So this is why the formalization project has been taken up with very, very required seriousness. Ministry of MSME also is doing. SIDBI also is taking up Udyam Assist project. The idea is that more and more micro and small enterprises should be given this number, so that they are brought under the ambit of formal sector, so that all the benefits that is accruing to them can be passed on to them. Fee charged banker yearly based on original outstanding amount, this we have clarified. what are different method of financing. I mean, we are open to everything. We give guarantee for term loan, working capital, even non-fund based also we do if it is coupled with some funded loan. So this also is done. Then another question: annual fee is levied on outstanding or sanction? It is on outstanding. It is on the outstanding one. Bank does charge annually. Some questions are there. Are GST charged above these fees? Yeah, this is the GST is charged above this fee, and they can set off when they do it. Do one needs to approach the state government separately and any separate approach? No, it is not to be done with the state government. Wherever we have done this collaboration, as I said, we will be the face of it, and everything will go as hitherto. They will go to the bank. The only difference is that instead of 75% coverage, they will get 95% coverage, and I only will be settling the cases. Again, with the difference that instead of 75%, I'll be settling the claims at 95%. CGTMC is available only once or so long as loan remaining outstanding below 5 crore. Yes, it remains valid as long as the loan is less than 5 crore. This is on tap. So it's not that once you have taken it is for all. We just see the outstanding. If you have taken a loan of 5 crore and the loan is cleared off, then again you can take a 5 crore loan where guarantee could be given. Practically, bankers tend to ask for collateral. Do we have data on sanction mix under CGTMC? We do have, I don't know what you mean by this question, but yes, but the collateral bankers ask, wherever they ask collateral and not come to me, of course, I'll not have that data. But yes, the hybrid section is there. That data is there, which shows that the bankers do take collateral, and over and above that, they come to us. As you are aware, RBI only says up to 10 lakh only one is prohibited. Beyond that, even RBI also does not say in as many words that you cannot take collateral. So there is a gray area in that. Practically, bankers tend to ask if this is done, are the fees same for all the banks, or it varies from bank to bank? It varies from bank to bank as per their performance. This is what has been asked. Any limit on working capital and project loan? No, there is no limit. The only limit is that 5 crore. Beyond 5 crore, the guarantee is not given. Some banks are very conservative and don't entertain CGTMC applications straightforwardly. They ask compulsory collateral. I know that this is a problem, but I mean, this is where we can kind of sit together and take a call and educate the bankers also, because ultimately this is a small and very effective way of moving towards 5 trillion economy. I am of firm opinion that waiting for a collateral and not giving a loan is not going to help anybody. Where a government institution is there which is giving you a collateral, why do you waste your time in where this additional or this collateral is not giving you any additional comfort whatsoever? So this is some education is needed for the bankers. We from our side, we have been doing consistently. Even today in Hyderabad also we have a seminar where the bankers are there and we are going to talk. I mean, our team is there which is going to talk about it. But I mean, this is a collaborative effort where we have to do something jointly. Due to increase, can the old loans which were not covered under the earlier scheme, can they covered under enhanced scheme get? Yes, this can be done. Whether CGTMC is available for new startup as they don't have any past history. New startup, yes, because if you see the startup definition, apart from that 100 crore they should not have reached, remaining every other thing, they would also qualify for as an MSE. So what I see is the MSE status. If they are an MSE, and if the banker is going to give a loan for a startup, I can cover. But I'll just tell you that there is a special scheme for a startup for venture debts that is being run by NCGTC. So I mean, this answer is yes and no. I mean, if a loan, credit loan, not venture debt, a proper credit loan is given for a startup, and if the startup meets the definition of MSEs, we will be covering it. Otherwise, it can go to NCGTC. Is it possible for a registered startup to qualify under this scheme with revised guidelines? I mean, I have answered this. Rural banks are generally refuses to go for CGTMC. They insist for collateral. What can be done? I mean, this is the other way around, sir. I mean, the rural banks are after my life that please onboard me and all. So many of the rural banks, they have also seen reason that going for collateral is laced with a lot of danger and a lot of potential fraud difficulties, delays. So they are also willing to go for CGTMSE scheme. But as I said, changing mindset is a long drawn out process where perhaps that is where I seek your support. Together we can do that. Can borrowers directly approach CGTMSE for the guarantee in advance? Yes, as I said, there is a portal, Udan portal, where the borrowers can go and they can get a we call it pre-approved guarantee. Pre-approved guarantee certificate. So that certificate is sufficient enough to establish their bona fide and their credentials for getting the guarantee. Bankers are not keen to fund a proposal as in case they say process to. Sir, I mean, as I said that now the things have changed a bit. Not a bit, it has changed a lot, because loans up to 10 lakh, straight away they can come and they can do. And my data says that in terms of number, 75% of the cases are less than 10 lakh. So basically for 75% of the cases, the settlement process is very, very simple, because there is no need of any legal action. So this may no longer be true. And operationally, even for more than 10 lakh also, we have simplified it a lot. I mean, if you happen to talk to any banker now, they will definitely give you a different picture. MSME manufacturing company need to apply for additional limit for GEC limit as announced in finance budget. How MSME can go forward? So they will have to go. I mean, about the limit and all, they will have to approach the bankers. And are there any schemes available for finance again invoice under this regime? As I said, the new scheme is coming. Maybe next month only this will come. It is called GST Sahay. And with that, the scheme is already there. Now the guarantee scheme also will come maybe within a month's time. By September latest, definitely it will come. Many private sector banks like Kotak, HDFC, Yes, Axis are only interested in unsecured business loan and not doing CGTMSE loan. Sir, this may not be correct. I mean, you'll be surprised to know that the highest number of guarantee amount-wise, last year was the first year when HDFC replaced SBI as the single largest bank for us, and the Kotak also was not far behind. So, in fact, my own even ICICI. So my own assessment is even the Axis, HDFC, Axis, Kotak, and ICICI. So my own assessment is all these big private sector banks, they are going very, very strong on. I'm in constant touch with them, and I get a sense that they are seeing a very improved potential by coming to CGTMSE. So this may not entirely be correct based on my own experience and based on the data that we have. Can we have CGTMSE for greenfield project that to majority of retail business through a commerce but have to manage huge inventory? It is already there, sir. So basically, my issue is that I am an intermediary. So ultimately, the loan has to be given by a banker. And once they give, then only they come to me. But suffice is to say that we are working on the scheme where greenfield projects, a special scheme may be launched, where somebody who is acquiring a skill and coming to the, it is like transition from a skill acquirer to an enterprise. And we are devising a scheme where we can provide a special guarantee to them. So that is a work in progress. So that will happen. So that's about the questions that we have. If anything more is there, then otherwise I am through.
Many questions are there, sir.
Yeah.
Due to scarcity of time, we have to get it to you, so that I'll send it to you.
Yeah, that would be great.
All the questions, so
Sure.
that we can take it in that one as we can put it in another way. In that one as particularly, we just share it out in the to the audience at large.
Sure, sure, we'll do that.
I'm inviting Mr. Sid Dwivedi for the next session on the trade financing. Right now, I'm handing over the session to Mr. Sid Dwivedi to take it forward of the trade financing.
Thank you very much. I think I am thankful to the ICI for being part of this webcast, and I think it was really a wonderful session by our respected co-speaker, the CEO of CGTSME. I think Mr. Verma has said the context and the tone of this webcast in a very wonderful way. I think we have been doing this trade finance part, or when we say this trade finance, so basically this is a trade finance, the umbrella term used for various financial instruments or the credit lines that we offer to the trading or the manufacturing community. So once again, thank you for and being part of this August gathering. So without maybe taking much of the time, I would be just trying to share my deck so that we can start with the presentation.
Mr. Dwivedi, you are not visible.
Sorry, I will just maybe there's some technical issue. Just give me a time. I will just connect. Again, try to connect. So I guess I'm facing some challenge in sharing my this presentation. So if you don't mind, Mr. Mishra, can I share this deck with you over mail, and maybe if you can help me share this deck? Yeah, Mr. Samit, am I audible?
Audible.
So can you help me share this deck with you? I'm just sharing it across to you over the mail, if possible, or else I will continue without the deck.
No issue.
Okay, just a moment. So, Mr. Mishra, I've shared. If you they send it across over the mail, can you please share it in the meantime? So maybe I will just start with without the deck in the interim. So I think the Mr. Verma has set the context
I have
for
not
the.
received the email.
Maybe it may take some time. I think it has been shot from my mailbox.
Continue with the session.
Yeah. So I will continue. No worries. So I think the crux or the very essential part which Mr. Verma had highlighted, that the trade finance, which has been mostly a collateralized based trade financing, which as part of the traditional banking we have been doing. Now there's a paradigm shift in the way the trade finance business is growing forward. So from it being a collateralized backed business to a credit insured business, I think that is what is the demand from the industry for quite long. And the very reason what I think was underlined or the underpinned was that we have a limitation the way the collaterals can be obtained from the borrowers. So going forward, I think we will be just trying to cover very briefly on the concept of the trade finance to begin this session. I know it's the August gathering and the audiences may be quietly unraised in terms of how this trade finance works, but still, I think the objective of this session is basically to establish the dialogue with the fraternity, the MSME fraternity, and through these dialogues, we want to bring the lot of awareness the way the banking services are there to fill the credit gap, the large credit gap which is there in the MSME segment. And needless to mention that MSME is the key driver in the way the economy in the economy. MSME still remains the, you can say, the biggest contributor in terms of the employment generation. The share of the MSME in the export is, I think, roughly 50%. That talks a lot about the MSME contribution in the economy. And as well as on the GDP front, I think they are roughly on the somewhere in the range of 23 to 25% in terms of the way the MSME sector contributes to the GDP. So setting this background, I just want to try to touch base with the various trade finance products and services which are available for the MSME segment, and also the regulatory framework, which basically you can say interplays with these services. And of course, the banks work within the regulatory framework of the RBI and other you can say incidental uh, uh, regulations. So we will just try to touch base with this segment. I hope it will be bringing some value to this session to all the audience. So talking about the trade finance in brief, so I will just try to give you a macro perspective about it, so that why trade finance is essential. So I think we are, or I think it's very conversant with the way that the trade, basically, we all know that it's the grease for any business. So until unless we have the trade finance available, I think the most of the MSME units will find it tough, or they will be struggling to keep with the expectation in terms of the growth. So if we talk about the banking terminology, we all know that the the cash conversion cycle of any business, it takes some time for whatever cash we are putting into the business to get back again into the form of the cash. So this cash that we're putting into a business, it goes through the life cycle of creation of the inventory, then putting up the required labor, and then maybe completing the manufacturing cycle, and then making the products ready for the sales part of it. Now we are ready with the inventory, the inventory which is ready to be sold. And then this stock gets converted into the receivables when we are actually selling this stock to the buyers. Now we know that most of the time, most of the sales do not happen on the cash terms. Most of the sales which we see are in the credit terms. So we find that the sales are outstanding in our books as the receivables. So in this process, for any entity to be still in a going concern basis, there is a huge credit gap which needs to be replenished so that they can continue the cycle of the credit conversion, cash conversion. Now here comes the role or the play of the trade financing. So as a business unit, they are always in need for the cash which can be replenished to purchase the fresh cycle of inventory and creating the next cash conversion cycle. So the gap which emerges because of the time when we have paid out the cash to purchase the raw materials and other inventories, and the time gap when it actually takes us to realize the sales. This is in actual terms, is the trade working cycle, working capital gap, which as a bank, as the banking entity, we are offering certain products or the trade products which in a way try to fill this gap so that the cash conversion cycle is smoothly replenished and the business goes on a smooth cycle. So I think that is what I need not highlight much or delve much into the subject of the what is why trade finance is necessary. So we all know that trade finance facilitates the growth of the business. It unlocks the capital from the company's existing stock or receivables. So the business entities can rightfully invest into the new cycle of the production and the receivables. Now it helps to reduce the payment gaps. So I think that is the key roles that the trade financing, I think, plays in normal process. So if we just simply try to understand, I'm again trying to touch base with a very elementary aspect of the trade finance, just in order to maybe set the tone of the or the to see that how the products have evolved over the period in terms of meeting the banks the requirement of the industry. So we see that the trade has evolved from a very, if you look at the primitive stage when it was almost on the barter system, that there was no currency engagement, when the communities were exchanging the commodities for fulfilling their requirement. Now thereon, we have moved on to the more of agrarian society, where the agricultural products and farms were being exchanged across the borders, or even within the community in a country, in order to fulfill their requirements. And then somewhere in the first half of the 18th century, 19th century, with the Industrial Revolution, which was mostly driven by the European countries, we see a lot of production capabilities being built up in the European countries, and we saw a lot of raw material getting imported from the colonized countries, and then finished products being again sold out to the various parts of the globe. Now, this has, over the century, or 19th or 20th century, this trade has grown at a mammoth pace. I think we all are aware that the way the trade has grown in the last 3-4 decades, it's all because of the information technology, which has somehow aided the growth of the production capacities. It has aided the way we exchange our communications with our counterpart across the globe, or even within the country. So now, from the Industrial Revolution, we are into the fourth leg of this evolution, which is something we call as information age. Now, I will also like to touch upon a very elementary concept of uh, the theory of the absolute advantage and the theory of comparative advantage. Uh, we all know that essentially that as an economy, we tend to produce certain products or the commodities where we are naturally endowed in terms of our capacity, in terms of our natural enrichments. And we find that we are able to uh, uh, produce it in a more effective and efficient way, and in a more economic way as compared to other the countries. So we tend to produce those commodities or the products where we have absolute advantage over the other countries, and that leads to the cycle of export and import. Now, another theory which has been, you can say, attributed to the growth of the international trade in the last 1 century is the theory of the comparative advantage. That basically says that while there are two countries which may be poised equally in terms of their natural endowments for producing certain products, but if I realize that by producing commodity A over commodity B, I'm able to be economically more richer in terms of the comparative benefit that I will be drawing from that commodity, I tend to produce more of it as against the production of the commodity B. So over the process of time, we realize that we have competitive advantage over certain products, and we tend to produce more of it as compared to product where we have lesser advantage, and that again leads to the surplus generation of that products, and we tend to supply it to the other part of the globe, and that again leads to the export and import business. So that is something, as I said, which was something on the background about the trade finance. Again, before moving to the more conventional and the structured product that we deal in, I would like to cover up or touch base with the various methods which are involved in the trade settlement or the trade finance settlement. So uh, I think most of the very commonly used trade settlement method is the cash settlement. We all know that cash settlement basically it emerges where mostly either the buyer has to pay the advance in full, or the seller may be getting the payment post the completion of the sales leg of it. So the buyer will be entitled to release the payment only after receipt of the goods. So this method, though very prevalent, but I think that it's very much, you can find that it is skewed in terms of the risk element, either towards the buyer or to the seller, depending upon whether this cash is in the form of the advance or it is an open account method. So this has been one of the very conventional method of the trade settlement over ages till I think the time when the banking uh, stepped in into this trade cycle and tried to cure this ailment through its entitlement as a you can say a credible entity or the because of it's enjoying the trust of both the parties, that is the buyer and the seller. So the banks step in as one of the you can say the intermediaries in terms of settling this payment through documentary collection. Sorry, Mr. Mishra, can you just go back to maybe the sixth slide? I think it will help the participants to connect to what I'm speaking. Or can you give me the control if possible? I can manage the presentation from my side. Yeah, one more. Yeah, this one. Okay. So, so now the documentary credit collection is also that is something you can say a sort of service that banks offer to the buyers and seller in order to mitigate the risk which are otherwise inherent in the former cash or the trade settlement methods which we talked about. That is the cash advance or the open account system. So documentary collection basically helps the seller to uh, get the payment collected through the banking channel, through the submission of the documents through the banking channel, and bank on behalf of the supplier or the seller presents the document to the buyer and demands the payment on behalf of the seller. So it appears to be more on the safer side for the supplier to get the funds collected through this banking channel, engagement of the banking channel. Uh, but nonetheless, the documentary collection method, though, sounds to be safer in terms of the former as compared to the earlier methods which I talked about. But there are also certain inherent elements of risk, or you can say it does not fully address the risk which are inherent in the method of the settlement. Uh, for example, the buyer may refuse to accept the document in case he finds some defects in the goods, or even if the buyer has accepted to release or to pay the documents, there may be the odd cases of the dishonoring of such payment commitments. So banks do not cover any risk or the credit risk which otherwise are inherent in any trade transaction in this method of the documentary collection. Now the more evolved or the more I would say the better or the method of trade settlement is under the letter of credits. Now we will talk about this particular product or the service which the banks offer to our MSME customers. Basically, letter of credit in a sense guarantees the payment of the transaction or the sales transaction to the seller, subject to fulfillment of the conditions which are stipulated as a part of this letter of credit issued by the bank. And these conditions basically deals with the way the documents are to be presented and the nature of the documents. On submission of the complete set of the requirements in the form of the documents, the LC issuing bank undertakes to honor the claim of the seller. So as we move and progress, I think we will be covering up some more aspect of this product in the following slides. So now we know that the trade finance gap, which in the form of the cash conversion cycle, we notice or we observe in any business life cycle. Now these can be funded either by the intra company when where the buyer agrees to pay the advance to the supplier so that he can use this funding to basically manufacture or prepare for the services which are required by the buyer, or uh, he can extend the credit terms to the supplier by giving payments or arranging the funds or the advance from the buyer on the credit rating which the buyer enjoys in the market. Now we find that the banks, how this trade credit gap can be filled by the bank, which we call that the bank intermediate credit or the financing. So bank basically fill up this trade finance requirement of the business in the two forms. One is the funded finance and the other is non-funded finance. Uh, Funded finance basically involves uh, disbursement of the requirement of the working capital in the cash, so that the cash form can be used to deploy in the credit cycle, the cash conversion cycle, and the business entity can use that funding for the running of the routine business operations for fulfillment of the orders. Now, the various funded finance, I think, which we will be referring to deck is with regard to the pre-shipment finance, the post-shipment finance, the warehousing finance, and of course the supply chain finance, which is, I think, more comprehensive term which we can use as a consonant to the trade finance. Now, on the non-funded side, which essentially does not require the instant funding of the capital requirement of the working capital requirement of the business, but they inform guarantee the payment or the honoring of the dues which are arising out of the business cycle. So the instruments which are used or which are offered by the banks to fund the working capital requirement in a non-funded way is in the form of the letter of credit or guarantees, and of course standby letter of credit. So pre-shipment finance, essentially, as we understand from this, because the terms which are covered in this presentation, I think they are synonymous in terms of both, whether it is a domestic trade or it is an international trade. So trade finance concepts, by and large, apply to both the sides of the trade, uh, except for the fact that in case of the international trade, the financing involves the forex part of it, and the forex risk or the currency risk are some of the additional elements which get attached to the trade financing. Uh, Excluding that, I think they are all these terms or the concept that we are covering up in here are something which apply to both the sides of the trade, that is the cross-border as well as the domestic. So the pre-shipment finance, basically, it is something we call as the inventory financing in terms of the banking parlance. So this finance is basically made available to the borrower to you can say complete the procurement requirement of the raw materials and all the processing cycle which he needs to undertake to complete the cycle or the manufacturing cycle and prepare the items or the uh, goods ready for the sale. So till the time the inventory is this financing basically, so the inventory is created. So the pre-shipment, all the sorts of the finance which are granted to the borrower fall in the category of the pre-shipment finance. So as you can see in this the process flow, so it basically starts with the entering of the contract between the uh, exporter and the buyer, or you can see the borrower and the buyer. Now, once this contract is completed, the borrower or the supplier, I can maybe to be on the to keep it simple, the supplier in turn requires the inputs or the supplies from the market to meet or complete the product for supplying to the buyer. Now, there in turn will be again, you can say backward contract signing, which will be between the input suppliers and the borrower. So the input supplier would be demanding the you can say the credit or maybe the upright payment for any supplies. So here immediately arises the working capital need for the borrower. Now the borrower can reach out to the lender with the at this stage with the requirement of uh, the funding. Now, which can be in form of the financing against the inventories. Now, we all know that in terms of the trade finance, the normally the traditional form, we as a bank offer the cash credit limit to the you can say the business entity to meet the running requirement of the working capital gaps that emerge. So in ideal case, such kind of requirements which emerge for the domestic trades in the pre-shipment stage get covered out of the cash flows and the funding that is made available to the borrower in the form of the cash credit, which is one of the most conventional product that is used. Uh, but however, in case of the export, I think the pre-shipment finance, which is something which is also coined as the packing credit, we call it as a packing credit to the exporter. So the exporter can reach out to the bank with the export order and can avail the packing credit advance, uh, which is on the basis of the export order available to him. So we will talk about I think some of the elements of the packing credit, I think, which may be of the interest to the participants. Uh, so the packing credit that normally that banks offer is for the maximum life cycle, which I again say it can even go beyond that depending upon the cash conversion cycle of the entity. But ideally, it is offered up to the 180 days against the export order or against the confirmed, you can say the letter of credit. So against both the instruments, the banks can offer the packing credit to the borrowers. Of course, it has to go through the proper sanction process that is required to sanction the any such credit limit to the borrower and fixing the limit for the packing credit as well. So uh, that is this, and again, this pre-shipment finance is something which is a self-liquidating facility. Uh, so mostly we find that pre-shipment facility is coupled with the post-shipment facility to the borrowers. And this post-shipment facility is offered against, you can say, the receivables which emerge out of the sales. Uh, so packing credit gets liquidated out of the proceeds of any such finance or the credit which the banks offer against the receivable arising out of the trade cycle. So post-shipment finance is something which is, as we were referring to as a receivable financing. So any receivable which emerges out of the trade cycle and the banks offer the credit or the lending against such receivables is coined as the post-shipment finance. Now, the post-shipment finance, maybe it can also be covered by way of the non-funded limits, like that is we call the letter of credit facility or the invoice factoring or the receivable discounting. So there are different terms with or different service products with certain nuances that we can say are available for availing this post-shipment finance. Now, coming to the supply chain finance or the payable finance. So now the supply chain finance is something which is a quite comprehensive term that is used for, you can say, covering the complete CCS or the CCC, that we the cash conversion cycle. It the scope of the supply chain finance extends to the you can say the buyer as well as to the supplier. We see that the supply chain finance has two you can say segments to it. One we call it as a payable finance, and the other we call it as a receivable finance. So when we say receivable finance, I think that is something when the supplier requires the financing under its the sales transaction, we cover it under the receivable financing. However, the supply chain finance, which completes the complete cycle or the trade cycle, the buyer can also avail the financing for the payables that it has against any trade transaction. So that is the beauty of the supply chain finance, that it covers the financing requirement of the buyer as well as the seller. Now, how these programs are created I think that is something is a different subject matter. I think we need to cover up maybe in a separate session on this topic. But as quickly as we can just see in the presentation, so if you can go one more slide before that, please. Mishra sir, I think, yeah. Ani, just one more back. Can you go back, please? One more, one slide back. Yeah. So as we can see in this process flow, that buyers enters into a commercial arrangement with their sellers and places the order. Now, the buyer receives the invoice with the payment details, so that what the supplier creates an invoice, there is an invoice on the buyer, and now buyer approves the invoice, basically. So the buyer is giving the commitment or acceptance, approval of this invoice that it will be paid on the due date. Now, the seller reaches out to the financer under this program, and the invoice or the receivables gets assigned in favor of the financer. Now, financer, upon the assignment of these receivables, funds this seller under the supply chain finance arrangement. Now, these programs are basically run on the concept of the anchor-based programs. Now, these can be a vendor financing program or the dealer financing program, depending upon whether it is a receivable finance or it is a payable finance. So, the supply chain financing model, basically, if we look at the way it has evolved in the last, I think, decade, though globally, I think the scale of the supply chain finance as compared to India is something it's phenomenal. However, the market is still evolving in the domestic front. I think the living example of it is something we call as a trades platform. Now, with more and more digitization, we are finding that the access to such platforms is increasing. More and more MSMEs are, I think, onboarding and the acceptability of the trading platform is increasing, I think, in a progressive manner. So when I say use the term the anchoring based programs, so many a times the banks are comfortable extending the credit facility to the large corporates as compared to the small, micro and small enterprises, as I think our co-speaker had very rightly emphasized this fact that there is a lot of challenge for the MSME segment in having access to the affordable credit. It's not just the affordable credit, but the credit itself, sometimes it becomes a challenge. Now, the building up of the platforms in the form of the trades and even some other, I think, a lot of fintechs coming into this space and offering the marketplace for various the lenders and the MSME to come on and onboard these kind of platforms. It has now started to build the gap, which I think was very much inherent in this market. And I hope that the way these fintech players are now evolving, I think the banks are also somehow systemically, I think you can say, adapting to the new changes that are occurring in this market. And going forward, I think we will see and more adoption of the such kind of platforms. And with the way, as again, taking the cue from the previous session, the API-based integration, which is again supporting this kind of growth. So with the single platform integrated to the various you can say the CRISIL, the bureaus, credit bureaus, the rating agencies, then the GST, and even other players like the information utility, which are basically the repository of various the record. So with these peripheral agencies being able to integrate with these kind of trade platform, I think it will become one of the core engines of driving the the credit delivery to the MSMEs. So that is my take on it. Of course, I think it will take some time to grow because we also need the regulatory enablers in terms of the reforms, some kind of the measures which are required from the regulatory angle as well. So I think one of the recent changes that we have seen in terms of more and more players, even the NBFCs being given the entitlement to be participating as a factor. So I think that these are some of the key elements which are, I think, driving the trade finance business in the right direction. And with more and more digitalization that is on cards, I think the yawning gap that we today see, I think that will be sooner or later be bridged. So I think that on the supply chain side, I think the other form of finance that is available to the business entities is in the form of the inventory or warehouse finance. So we find many times that there are certain ready inventories which are still not sellable, or which are in a finished stage, but they are not sellable. Uh, and a business entity basically is short of the working capital, since this inventory, it's locking its the working capital for some time. So the banks are offering the lending against such kind of warehousing, where the collateral managers, which basically are the intermediaries which play the role of the providing the security of these warehoused uh, uh, goods. So based on the agreement with the CMAs, the and certification that the CMAs issue, the lender can fund the requirement or working capital requirement of the business units. So the inventory or the warehouse financing is one of the trade finance products which, by and large, most of the banks are offering, and specifically in the MSME segment. So I think that is one of the important business for the SME segment that most of the banks are currently trying to grow their books. So now coming, so these were all about the funded products that the banks are they offering to the MSME sector. Now, on the non-funded side, the letter of credit is the product, which is largely, I think, instrumental in the way the business is conducted, and more so in the international trade. Letter of credit instrument has been, by and large, one of the important instrument fueling the growth of the cross-border trade. So, in very simple terms, the letter of credit is basically the undertaking which the bank takes to make the payment to the seller on behalf of the buyer of the goods, up to the committed amount, which is specified in the credit. And this commitment or this undertaking is subject to the fulfillment of the conditions which are part of the credit document. And these, as I talked about earlier, these conditions are basically concerning the documentation part of the trade transaction. So the supplier needs to submit the complete set of the documents which are required as part of the contract between the buyer and the seller. And those documents should be reflecting the terms and the conditions which have been made the integral part of the letter of credit. And on finding the correctness of the documents, the LC issuing banks honors the documents unconditionally. So I think letter of credit is some instrument, I think, which still remains the most credible instrument in the domestic as well as the international trade. Now, the standby letter of credit, as well as the demand guarantees, these are also the important instruments which the credit instruments which bank offer to the MSME clients to meet their the business requirement. So these instruments are largely required in case of certain obligations which the supplier or the business entity have towards meeting any contract or the performance under the contract. So the mostly we find that guarantees in the form of the bid guarantees, which are required for participation in most of the government bids. Then the performance guarantees, which are required under the contract as a commitment on the part of the business to fulfill the performance as required under the contract with the employer. Now, I think in the last part of this session, we will just quickly run through some of the critical elements which interact with these products and the services, and somehow are quite, you can say, critical in shaping the way the business or the trade financing business is conducted by the financial institutions. So, on the regulatory side, before I think we just quickly we will touch base with the kind of risk which are there in the trade finance business. As I said, that these are the risks which, as a lender, the banks have to be conversant and be wary of, because these risks are somehow inherent in any trade transaction and can be, uh, uh, you can say, snowballing into, you can say, the default and deterioration in the health of the account. So these are the risks which I think most of the lending institutions take care of while setting up any credit limits, and even during the course of any lending activity, they just try to see that the quantum of risk that the business is having in these particular categories. So the product risk, that what is the nature of product, what is the perishability of the product, and the seasonality of the product, and how this product is placed, and what are the demands of this product in the market. So the manufacturing risk, otherwise, as we all know, that they can be manufacturing risk in inherent to any such manufacturing business. Transport risk, of course, the transport has its own perils and the risk. So which of course can be covered by way of having a transit risk insurance by the businesses. And the banks promote or encourage the business entities to get their transport risk covered through the transit risk insurance, which are available in the market. Currency risk, of course, this currency risk is something predominantly which we see in the cross-border trade because of the exchange fluctuation. The business may have this peril of facing the exchange, adverse movement of the exchange, which goes against the finances. And so this currency risk is a very much integral part of any cross-border transaction. So of course, as a lender, we tend to see that what is the scale of the exchange risk that any business entity faces, and what are the various ways the business entity can cover those risks, whether there are certain natural hedges available to the entity in the form of the counter trade that the business may have, which somehow nullifies the risk because both the sides are exposed to the exchange risk, that is the purchase as well as the sale, and because of the counter effect, this exchange gets nullified. So the bank always tend to identify if the business entity enjoys any the natural hedge. Otherwise, the bank encourage the entity to go for the various hedging instruments which are available with the bank in the form of the forward contracts or the options or other more sophisticated instruments which may be enjoyed by the entity, subject, of course, to the risk which are again attached to such kind of hedging instruments as well. So now on the regulatory framework side, we will see that there are various agencies which have certain influences on the way the business, the trade business is conducted, and how the banks are regulated in terms of their functions or the activities on the lending side. So of course, the RBI is the umbrella agency, the governing, you can say, the body which takes care of the lending, basically defines the contours of the lending, the way the lending is conducted. So as a lending institutions, we are very have, you can say, very closely regulated and governed, and as well as monitored in the way the lending activities are carried out by any financial institutions. Now, another important aspect which again comes into play is the Foreign Exchange Management Act. So, in case of the cross-border trade, uh, uh, so so the any foreign exchange purchase or sale, I think that falls within the ambit of the Foreign Exchange Management Act. So. Uh, RBI being the paramount institution which is uh, authorized or as per the, you can say, the provisions or the statute enshrined in the FEMA, RBI issues the license or the authorization to the various institutions. So, as the authorized dealers, banks are entitled to deal in the foreign exchange. However, within the control framework which are laid down in the forms of the rules and regulations given under the FEMA. So, any lending or that the banks do in the foreign exchange, any financing that is done in terms of the foreign exchange transaction, or any lending done directly in foreign exchange itself gets covered under or governed under the Foreign Exchange Management Act. And we have to very closely monitor that these activities are falling within the contours of the framework. Now, DGFT. So DGFT, as I said, is uh, the regulatory body which covers the cross-border trade and issues the foreign trade policies. The way the foreign trade has to be conducted, so that the entire framework, the regulatory framework, is built under the aegis of the DGFT. So just I think since recently the foreign trade policy I think has been rolled out by the DGFT. So just key elements of this foreign trade policy, which I thought are worth sharing with the audience, is that there is a paradigm shift in terms of the how these foreign trade policies have been, been designed prior to this regime. Uh, so I think this foreign trade policy brings maybe a sort of, I don't know how this news is taken by the exporter community, that it does not give any incentives in the form of the merchandise export incentive scheme or the service export incentive scheme, which were otherwise available in the earlier regime. Now, it is again on the background of that there are certain, you can say, the legal issues which the country has faced in the international court, and we cannot continue to provide subsidies or the incentives to our export based on certain the guidelines as per the international conventions that we have subscribed to. So, because of that, I think the incentives which were available to the exporter community have been withdrawn under this new foreign trade policy. Of course, I think there are measures to complement or supplement this incentives by way of some other measures, which of course are again subject matter of the deeper study of the foreign trade policy. But the I think the move of this the foreign trade policy, as we can see in this point, is that it is focusing more on the digitalization part of it. So when we talk about digitalization, I think that is very much evident in the way that we deal in the foreign trade by way of the introduction of the EDPMS and the IDPMS, the digital BRCs that are issued for any export realization. Even on the bank guarantee side, I think the recent development that I would like to share with the audience is in the form of the electronic bank guarantees. So we see that there's a lot of digitalization move that is happening across the banking space. And I think this foreign trade policy very correctly resonates with the requirement in terms of the digitalization or the digital go digital scheme, which our I think the policy or the current regime is focusing on. So, see, the one last, I think, a couple of more points in the foreign trade policy, which I would like to touch, is that I think there's a more focus on the district-based export now, instead of focusing on just the key, you can say the centers which were identified as the exporting hub, now the focus is more going inwards toward the districts. So I think there's a process to identify the districts which are having expertise in terms of certain products which can be I think uh, focused upon for growth. For maybe in a more formal way, they can the growth trajectory can be achieved by focusing on certain more localized products and the exports. Now, with this, I think I'm reached the end of the this trade finance session. So, in case if we have questions, I can maybe in the remaining time, I think I will try to address any queries of the participants.
Look at the chat box. Questions are there.
Now, see, I think if debtor becomes insolvent, then what is remedy? So now there's a complete process. I think that I think again is that something which not essentially deals with the trade finance, and I think the insolvency and bankruptcy code. I think that largely covers the way this things need to be dealt with. Then there's a complete mechanism of going for the recovery of such the advances. So I think that should I may not be getting it covered in this response or within the remaining time. Now, how to mitigate risk of the buyer where he has to pay to the bank, even in the case of not receiving the goods or receiving the goods not in accordance with the contract from the seller, because the bank has already paid the seller when they have provided all documents. Now, I think this is something is a very, I would not say use the word dilemma, but something it's more of the awareness and the education part about the letter of credit. Now, being a very trade specialist and having worked in the trade operations for quite long, we find that the way these trade letter of credit are structured, I think most of the time there is a very casual approach in the structuring of the letter of credit. Uh, the way I think these are somehow some similarly, we find that we tend to just follow the same format or the same clauses which are part of the previous transactions without even understanding the nuances of the particular trade. Now, I have no ready-made answer to this because it is again it's a matter of dispute, and there are a lot of disputes in the even in the international courts which are going on such subjects. But as far as the bank's position is concerned, the banks will be under the obligation to honor the pay claim if made in accordance with the LC terms. Now, how such the downsides can be avoided? I think the answer lies within the letter of credit. So how we structure the letter of credit, what kind of clauses which we are stipulating in the letter of credit, and how we are trying to ensure that such kind of you can say the frauds. I will not use the word fraud, but maybe such defects may emerge in the trade transaction. The second piece too is that mostly, though many times as a business we do build up certain conditions, these conditions are not backed by way of some documents. So I think it again becomes a subject matter of the UCP and how this UP 600 covers these kind of situations. But the very important tenet of the letter of credit is that uh, any condition has to be substantiated by way of a document. And that requirement has to be very clearly spelled out in the letter of credit. In a situation that when I'm giving a condition, but I'm not stipulating the requirement of submission of the document which evidences the fulfillment of that condition becomes void. So I'm just trying to draw some kind of reference to the various situations or the cases that I may have personally encountered. So these are the reasons which may have led to this situation. But again, I don't have ready-made answer to this situation. But the way you can mitigate the risk as the question goes, I think that the answer lies itself in the way we are structuring the LC. Our purchase are blocked in China due to restriction made by India. So many are blocked as packing credit is overdue. Then what is the remedy? So now, again, see if there are certain country risks which are there, of course, in the involved in the cross-border trade. Now, I'm totally unaware of the reasons why these goods, the transaction are blocked, whether it is related to the OFAC sanction or whether it is in violation of any our the trade policy. Being unaware of these facts, my answer, I will cut short my answer to the fact that if it is a genuine position, uh, of course, there are remedies which are there available under the export credit guarantee scheme of the CGC. And if it is getting covered in the same, I think that is the remedy which is available to the exporters. So I think I have done with all the set of questions, and we are on the sharp 6. I think this is the end of the session. So I thanks
Thank
once
you.
again. I
Thank
thanks
you.
the ICI for inviting me for taking this session. I really feel privileged to be part of this session, and maybe I believe that I've been able to bring some of the elements or the moot points of the trade financing. So thanks once again to the audience and the ICI team. Thank
We
you.
are thankful to Mr. Sandeep Verma, CEO, CGTMSE, and Mr. Sip Dwivedi of the IDBI Bank for their derivation to us. That one is CGTMSE schemes, as well as that one is trade financing. This is the beneficial session for the members at large. And we are once again thankful to spare the valuable timing with us for this session. With this, we conclude the session. We once again thankful to all of.
Thank you. Thank you very much.
Thank you. Thank you.